I want to ask you about Jeff Gundlach. Last night, he was discussing, saying that there is a lot of BBB rated debt that should actually be rated as junk. You are a distressed investor. What happens if that re-rating happens in your mind?
Well, I haven't seen Jeff's report yet, but he's exactly right. If you think about the market today versus 10 years ago, the BBB sliver of the investment grade market in 2008 was about $700 billion. Today, it's approaching $3 trillion. It's half the investment grade market. And in a recession, historically at least, 10 to 20% of BBB rated investment grade become fallen angels. They get downrated to junk. If you look at the leveraged credit market, okay, so levered loans and high yield bonds, that was $1.3 trillion back in 2008. Today, it's approaching $3 trillion. So if you add those two slivers up, the sort of already junk-rated debt and the at-risk portion of the investment grade, the market's gone from $2 trillion to $6 trillion. So the implications are two. One, today, there's a lot to do, even though the economy is still growing at a 2.5% clip. But what Jeff's worried about, I assume, not having read his report, is that if we do get a slowing in growth, the size of the market could be gigantic. You could have a very mild recession relative to 2008, but have a distressed debt market that's as large, if not larger, just because the size of the market is so big.
Now, this is a time of perennially low interest rates, where companies can borrow for cheaper, and therefore they're not as distressed. Where are you seeing the most opportunities right now?
We put 10 new positions in the firm this year, very diversified across industries. The theme, if any, is twofold. One, over-leveraged. And that's back to what we were talking about before. When you have good economic growth and low interest rates, it encourages companies to borrow. So you've seen a lot of excess risk taking. Two, most of the U.S. economy is made up of small and medium-sized businesses. So a lot of these companies are smaller in nature, $1, $2, $3 billion in enterprise value.
Now, I want to ask you about oil. I know you have some investments in that sector. We've seen stockpiles of American oil growing. I mean, do you think that companies are still producing too much oil? What is your assumption for an oil price where you see American shale producers continuing to go hard?
Yeah, the energy sector has been an interesting one. Most people, including us, have had a very difficult time in energy in 2019. But if you're a contrarian, and we fancy ourselves contrarians, you're supposed to be focused on the industry today. Long-only funds have historically averaged around 8% holdings in energy. Today, that's averaging around 1.5%. Right? And guys in the alternative space have been kicked around in this space this year. So what that means is you're looking at record low multiples at a time when at the fundamental level, managers have gotten very disciplined at the company level. Right? The rig count, which peaked at 2,000 back in 2015, is down to about 800 and declining. Mm-hmm. So you put those two things together, disciplined management teams focusing on cash flow, return on invested capital, and record low multiples in the industry. If you're a contrarian, you're supposed to be spending time on the industry.